when you quote those FX reserve numbers, right, those importantly are only other FX currencies, right? Those are only other fiat currencies. Once you include gold into the mix as an FX reserve, the picture changes entirely, because what you would see is that the dollar's share of FX reserves plus gold is down to 46%. It's already a minority. And gold is up to 30%. So after another couple years of 1,000-ton central bank gold purchases, and let's say another 30, 40, 50% rise in the price of gold, gold will be bigger than dollars in global FX reserve terms. And that's going to be a really interesting moment of cognitive dissonance for people talking about the dominance of the dollar and the dollar system's never going to change, when gold is a bigger part of global FX reserves than the dollar is. If gold is the biggest FX reserve asset, not dollars, is the dollar still the primary reserve currency?
Financial analyst Luke Gromen highlights a critical transformation underway in the global monetary system. He explains that when analysts discuss foreign exchange FX reserves, they typically reference only fiat currencies, overlooking the vital role of gold. However, once gold is factored in, the data paints a dramatically different picture. The US dollar's combined share of total reserves, including gold, has dropped to about 46%, while gold now represents nearly 30%. This marks a significant shift in financial power, reflecting not just diversification, but a deeper structural move away from dollar dependency. According to Luke Gromen, this transition is accelerating as central banks around the world continue purchasing thousands of tons of gold annually. Should the metal's price rise another 30 to 50% in the coming years, gold could soon surpass the dollar as the dominant global reserve asset. Such a milestone would redefine how nations perceive monetary stability and asset security, challenging the long-standing notion of US dollar supremacy. Gromen further suggests that this emerging reality will create a profound moment of cognitive dissonance among policymakers and investors alike. For decades, the global economy has been anchored by dollar hegemony. Yet, within 2 years, the balance may tilt toward gold as the world's primary reserve benchmark. If gold becomes the largest FX reserve component, the question naturally arises, can the dollar still be considered the world's reserve currency? His analysis implies that this is not merely theoretical, but an inevitable outcome of shifting trust, sovereign diversification, and the re-emergence of hard assets in global finance. Before we dive deeper into the discussion, take a moment to subscribe to the channel and turn on the notification bell so you stay updated with every new insight and analysis the moment it drops.
Oh, I think it'll work. I think it is working. I mean, when you quote those FX reserve numbers, right, those importantly are only other FX currencies, right? Those are only other fiat currencies. Once you include gold into the mix as an FX reserve, the picture changes entirely, because what you would see is that the dollar's share of FX reserves plus gold is down to 46%. It's already a minority. And gold is up to 30%. So after another couple years of 1,000-ton central bank gold purchases, and let's say another 30, 40, 50% rise in the price of gold, gold will be bigger than dollars in global FX reserve terms. And that's going to be a really interesting moment of cognitive dissonance for people talking about the dominance of the dollar and the dollar system's never going to change, when gold is a bigger part of global FX reserves than the dollar is. If gold is the biggest FX reserve asset, not dollars, is the dollar still the primary reserve currency? I don't know, but I can tell you that's what we're going to be within 2 years. Now, I think the way they are setting up, I've seen a couple reports of it. Hong Kong's really the only one I've seen so far. There have been rumors of Saudi and others with these local country vaults. It would be a brilliant way to do it, because ultimately, again, here the deal is the Americans will let you buy gold too, but you got to leave it in New York, and the English will let you buy gold, or you got to leave your gold, your American gold, gold from trade with the Americans in London. And oh, by the way, like we let off the show, the Brits have already grabbed Venezuela's gold, right? That gold is not safe. Or the Chinese system is, hey, don't trust us. We'll put a vault, an SGE vault, Shanghai Gold Exchange vault, in your country, and we'll store that gold in your country. That's a pretty good offer. And I think ultimately, like I said, it's not about them attacking the dollar per se, but rather, like you said, the dollar has been weaponized repeatedly. So it isn't a defense against that. And it's a defense against China's own vulnerabilities that we discussed before. And it's using what is ultimately, and what has always been, the dollar's Achilles heel. The dollar's Achilles heel has always been the unallocated gold market centered in London. which is, right, if the price of gold goes to the moon, what does every person say? Most investors say, well, if gold goes to the moon, that discredits the dollar, that threatens the dollar, that threatens dollar dominance. For the reasons we just discussed, it'll be a much bigger part of global FX reserves. Well, part of the way that price of gold, that dollar dominance in London has historically been managed for the last 50 years, or certainly a lot of the last 50 years, has been through the expansion of unallocated gold derivatives, credit gold, centered in London. And so that's a fancy way of saying if demand for gold rises, there's two ways that can be addressed, right? Gold is relatively fixed supply. If demand for gold goes up a ton for whatever reason, like in the 70s, if it kind of continued into the 80s, you can let the price of gold rise and let the free market, right? Price will settle, will balance, will demand and supply. But when price of gold rises, that has major macro implications for the dollar and everything else. Or you can leave price where it is, and then you can allow the unadulterated expansion of unallocated paper gold claims. In other words, you can sell 100 paper claims on every ounce of gold, and thereby, with credit gold, satisfy demand on some level and keep prices contained. I don't know the degree to which that has happened in recent years, but historically it happened in some fairly significant way, and we've seen glimpses of that through history. Not least of which back in the late 1990s, where there were some real issues around that. But the point here is that as China facilitates this drain of London gold, it puts, through expanding trade as a net settlement asset for yuan-denominated commodity trade, over time, at some point, it starts to put upward pressure on physical demand in London, and then that forces US, UK policymakers into a choice. How much gold do we let go before we start letting the price of gold rise and just let markets work? And I think we're sort of beyond that point based on what gold has begun doing in recent years. What I can tell you, I don't know if they were pulling it out of gold or not. You saw a gentle decline in gold LBMA volumes around the city. If I'm going from memory, earlier this year, last year. But what I do know is that you could see in U.S. trade statistics starting around December of last year and into the first quarter of this year, somebody was importing so much gold into this country that it had knocked down GDP into a technical recession. In other words, we were importing, and it was gold. There were so many gold imports that the United States, I don't know, whoever tracks that, Bureau of Economic Analysis or Department of Commerce, whoever it was, they were literally stripping gold imports out of the economic data because it made it look like GDP was falling 4% in the first quarter. And when you do the math, again, I'm going from memory here, but I want to say it was like $500 billion in annual, $500 billion at an annualized rate of gold imports. So it was a lot. So somebody was bringing a lot of gold into the United States. We don't know who it is, but having had conversations with various market players over time in that business, and even looking at what we can see publicly throughout history, right? When the Hunt brothers in 1980 tried to create a run on physical silver and the system did not want that to occur, they turned COMEX silver into a sell-only futures market. And they basically said, you're not allowed to do that, right? When you look at COMEX inventories, at any given day, you can look at COMEX inventories, multiply it times the price of gold, and it's, in the grand scheme of things, it's not that much gold. And so in theory, at any moment in time over the last 10, 20, 30 years, any medium-sized hedge fund who are very profit motivated could have showed up at COMEX and said, I'm going to buy all these gold futures, I'm going to demand physical gold delivery, I'm going to break it, and we're going to create this super spike in gold, and I'm going to get rich. And yet none of them ever did. And my point here is that gold is a political metal. You don't just to get to be a private market player, show up and squeeze gold for all the reasons we just discussed. It's a lot more than just some, pet rock commodity trading thing. It is still a systemically important asset. And so my point here is that whoever was bringing all that gold in had to have been systemically important. So I don't know, and had to effectively have had the blessing of the U.S. government to do that. So whether that was Treasury, whether that was a systemically important financial institution, or in the parlance, too big to fail bank, I don't know. But a gun to my head, I would if I had to guess, it was either the U.S. government or somebody with the U.S. government's blessing or acting as agent for the U.S. government, and specifically the U.S. Treasury.
Financial strategist Luke Gromen explains that gold's resurgence as a global reserve asset is redefining international finance. Traditional FX reserve data reflects only fiat holdings, but once gold is included, the US dollar's combined share drops to about 46%, while gold now represents nearly 30%. Gromen predicts that, with continued central bank purchases and higher prices, gold could soon surpass the dollar as the largest global reserve component. This would mark a historic shift, challenging the notion of the dollar's unshakable dominance in world trade and reserves. Moreover, Luke Gromen highlights China's strategic approach, offering sovereign gold storage through local Shanghai Gold Exchange vaults as a safer alternative to Western-controlled systems in New York and London. He stresses that as physical gold increasingly flows eastward, the traditional leverage of Western vaults weakens, signaling the rise of a new gold-backed financial era.
I do think there are those numbers don't exactly make sense. It is a relatively opaque market. Why are they buying it? They are buying gold for two reasons. Two primary reasons, China in particular, but others as well. The first is that it has become very apparent to I think everybody around the world, most everyone around the world, certainly at that level, that over the last 5 to 10 years, the only way the U.S. and the West more broadly can afford to sustain their debt levels is by having negative real interest rates. In other words, having the rate of inflation, nominal growth higher than the interest rate on the bonds. And so if you are a creditor of the United States, storing the wealth of your country in bonds whose rate of inflation is below, or whose rate of interest, is below the rate of inflation, that amounts to effectively a slow expropriation of your nation's wealth by the Americans. And that's not acceptable to any number of other countries. And so the way you combat that is you own gold. Gold preserves your purchasing power over time. The other major reason they're doing this, and have been for over a decade, particularly as it relates to China and Russia, is that with the weaponization of the dollar and with the position that China and to a lesser extent Russia are in, China does have a very serious issue that's been identified over the last 10, 12 years by a number of different people, which is if, as they continue to grow their economy, they need to buy and import more and more oil and other commodities, and I'll just say oil for short, they need to import more oil to support the growth of their economy and support the amount of debt that they have. The challenge for China is that China has a finite number of dollars in their FX reserves, and oil, up until a few years back, was only priced in dollars. And so as China was facing a situation about 10, 12 years ago where they were looking forward to say, okay, well, we need to keep growing in order to, sustain our debt and maintain political legitimacy in China. And so we're going to be importing more and more oil and other commodities, and probably means oil prices are going to be going up over time. And so as we import more oil at higher prices, all in dollars, against our finite store of dollars, we're going to run out of dollars. And when we run out of dollars, we are going to have a late 1990s Southeast Asia currency crisis. We're going to have to devalue the yuan. We're going to have high rates of inflation. We're going to have a very big drop in living standards. And that is a serious crisis that would lead to questions about political legitimacy in China. And that is simply a non-starter. And so problem is that while they recognize that problem, they also want to not open up their capital account. They do not want to have free flow of capital in and out of China because they're afraid of a run on yuan that way. And so what they did is come upon a pretty innovative solution, elegant solution, which is they have spent the last 10, 15 years establishing offshore yuan clearing banks and finding oil exporters and other commodity exporters willing to sell the marginal barrel of oil and other commodities in Chinese yuan. Now, why would Russia sell oil in yuan? As much as Putin may not be happy with the U.S. these days, he would still trust dollars over yuan. And the answer is China has provided for net settlement of yuan surpluses that oil exporters would earn in this case in physical gold. So if you are Russia and, oh, by the way, you're getting sanctioned by the West, so you're looking for ways around the dollar system, Russia can sell oil in yuan. They end up with yuan surpluses from selling that oil. And the system that the Chinese and the Russians have been working on for over a decade has been surplus yuan can be used to buy all the goods that are made in China, the factory of the world, and which are getting to be higher and higher quality goods. And if Russia or whoever else still has yuan left over by virtue of this trade, they can recycle that into gold that floats in Chinese yuan terms. And that's a really important part of the deal, because no one may trust the Chinese government, but everybody trusts gold more than the dollar. So China learned from the mistakes of the US in the 70s. So when we went on, post World War II, Bretton Woods gold standard, there were two mistakes. Number one, the US pegged the price of gold to the dollar. That was problem number one, which is very restrictive for the U.S.'s ability to run deficits. As we later saw, we had to go off the gold standard because of deficits around the Vietnam War and LBJ's Great Society. The other problem was we used our own gold to satisfy those claims. So we basically had to supply the gold. And so not only did we fix the price of gold to dollar, which is a mistake, but everybody knew what we had in gold. And so you could see the size of our deficits relative to our pile of gold. It was very obvious to the whole world by the mid 60s. There was no way we could cover what we had written in terms of IOUs out of our gold without devaluing the dollar versus gold. And immediately that touches off a run on gold. So what the Chinese did to fix these two mistakes is number one, China, the price of gold is allowed to float in yuan. There is no fixed rate that China is exchanging this at. And that is important because Treasury Secretary Connolly in 1970 famously said, the dollar is our currency, but it's your problem. In other words, we're going to run these deficits, we're going to inflate, and there's nothing you can do about it. You're just going to have to eat it with your debt holding. The Chinese, the way they're treating gold, allowing yuan gold to float in yuan terms is, hey, sell us oil in yuan. If you end up with net yuan surpluses, you can buy gold with it at these offshore clearing banks around the world, which, oh, by the way, are located in gold trading or refining hubs like London, Singapore, Dubai, Switzerland. And then the gold will go up or down based on how we manage our finances. And so if we, the Chinese government, keep inflating, then the price of gold in yuan is going to go up. Your purchasing power of the gold reserves you have from doing trade with China is going to buy you more stuff from China. So it's the yuan is our currency and it's our problem. Basically, sets up a virtuous cycle of trade, whereas the American, our currency, but your problem, requires the Americans to take purchasing power from treasury holders. The Chinese system, as they have set up, allows gold to rise to preserve and or grow purchasing power in yuan terms for their creditors, which then has them buy more yuan goods, which then has China buy more oil, which means you get this virtuous cycle trade. So that's change number one. The other thing the Chinese did that's pretty elegant is the Chinese aren't allowing gold in mainland China to circulate to settle this trade. In other words, once physical gold goes into mainland China, it can't leave. There are still capital controls on gold. But Hong Kong, it can come and go. The Shanghai Gold Exchange International Board in Shanghai, there's a free trade zone where gold can come and go. And so essentially, China is using the gold in London, the gold in New York, and the gold, they're essentially creating a short squeeze in gold prices higher because their gold is not allowed to move. So they can't run out of gold. And oh, by the way, because they've been encouraging their citizens to buy gold since 2002, the government has, as this Chinese trade drives the price of gold higher, it also recollateralizes balance sheets in China. So the people that may have bought an apartment and are now underwater because apartment prices have fallen, they also own gold in all likelihood. And as the price of gold rises as a result of this, their balance sheet improves. Chinese commercial banks own a lot of gold. Their balance sheet rises, increases the amount of collateral they have. The Chinese government owns way more than they've said. So those are the two ways. Is number one, they're not pegging it to the yuan. And number two, they're not using their gold to settle these things. They're using everybody else's gold.
The global shift toward gold reveals a profound rebalancing of financial power as nations seek protection from inflation, sanctions, and Western monetary dominance. Over the past decade, China and its allies have systematically built a parallel trade network that allows oil and commodities to be settled in yuan, with surplus currency redeemable in physical gold. This mechanism not only strengthens trade autonomy, but also safeguards purchasing power against the erosion caused by negative real interest rates. By allowing gold to float freely in yuan terms, China has avoided the pitfalls that once forced the US off the gold standard. But the real question is, what happens when this system matures and gold outshines the dollar as the true store of value? The answer may redefine the global order of wealth and trust, If you enjoyed this analysis and found it insightful, don't forget to hit that like button and share your thoughts in the comments.